Hey, if we move on to another topic, you've got a calculator to help with borrowing expenses. We just talked about depreciation, which is depreciating a tangible asset, but sometimes you have this word amortisation, Rob, which is for some people not as obvious as depreciation, but borrowing expenses falls into that category. Can you talk to us a bit about that and how you guys have got some tools to help?
Yeah, that's right, Bryce. So when your borrowing expenses are more than $100 in total, which is almost everyone these days, right? Then you need to calculate and spread your expenses over a 5-year period, or the term of the loan, whichever's shorter. And so odds are that you won't be buying your property as well on 1 July at the start of the income year. So you also need to pro rata that between the first year and the last year, depending on how many days in the year. So we have a new borrowing expenses calculator, which will help you to get that expense right. And just as you kind of put your records together, put all the figures in, then that'll help you to get it right. And you can find there's a borrowing expenses fact toolkit you'll find in a fact sheet around this in our investment toolkit, because we'd also see some misunderstanding around what's considered a borrowing expense. And so it's important to understand what you can claim as part of the borrowing expense, and then how you claim that over a period of time.
Great. And some examples. I mean, what we aren't talking about here is the interest expense. We're actually talking about the expense that may be charged as part of the borrowing setup or exchange. So things like lender's mortgage insurance. We're talking potentially about the fee that the bank may charge you, such as an annual fee associated with setting up that particular loan with that particular institution. So that's why this borrowing calculator will be really helpful for people to get a sense of what is claimable and what might not be claimable.
And
Yeah,
Ben, stick around for my life hack because I'll have a bunch of resources that people can get access to follow up on all these awesome points that Rob's speaking to. But sorry, Rob, I'll cut you off then.
no, I was going to say a good example is stamp duty on the loan is a borrowing expense. Stamp duty on the property is not a borrowing expense, right? So, so some of these things are important, and you can work through the calculator, and the fact sheet helps you make sure that you're claiming the right things.
Yeah, I think the ATO wants to make sure people get that right because amortising the stamp duty on the purchase would be good for the investor, but the ATO would not be happy about underreporting there. Hey, if we pivot to Ben just talked about interest expenses. It's definitely one of the, if not the biggest, the definitely the biggest expense for property investors. But surely everyone would claim this perfectly, Rob. No one would overclaim on this one. Come on, surely not.
So, look, Bryce, overclaiming interest is an issue we see, and people do get wrong. So interest paid is immediately deductible, but only the interest on the investment property. So this means that if you've taken the loan out for more than one purpose, like buying a new car or if you've got an investment property, spending some money on renovating your own house that you live in, you can't claim the part of the interest that relates to the private use or the other element. So we do see some confusion there. Also, the thing to remember is you've got to do that over the whole period of the loan. So if you've used 20 grand to go on a holiday to Europe as part of the finance facility, you can't pay the first 20 grand back and be like, all right, everything now on is the investment property. You need to apportion that over the period of the finance facility as well. So it is an area we do see some confusion. And look, incorrect reporting of interest expense accounts for about 42% of the tax gap for rental properties. And the tax gap for rental properties, the total is $1.2 billion. So it is a fair amount of cash where we're seeing people get it wrong. And we do have a lot of data, as we talked about earlier, from banks and other lenders that does give us an insight into kind of actually how much interest people are paying.
It's a really good point, and I know, Rob, you won't be able to comment to this, but we see quite often people using refinancing facilities that they might be in advance in terms of redraw, and to that point they then go and borrow that money back out, and then they don't adjust for that interest calculation. So that you make a note here of a $420 million problem in interest or overclaiming of interest, which is that sort of 42% you're referring to. So it really is very, very important. And on that point, we talk about line of credit facilities, and Rob made mention of that in terms of going on the European trip and then sort of paying that off as part of a facility you've got. We cannot stress enough for our community to separate out activities. So if it is for investment purposes and it is for the property, make sure you've got your lending structure appropriately set up so you don't have mixed purpose of uses, because that's where most of the problems generate from. So a good structure, and remember, lenders can give you great ways and multiple splits in loans, and it's getting easier and easier through a lot of lenders to set up those different splits for different purposes. And that just makes the administration work of looking after what is deductible and what is the purpose of those funds a lot easier for you to manage, but also in the event that the ATO does do a check on you, that's really clear for them to see basically the delineation of those different expenses and how you're claiming those. So I can't stress enough about getting the administration right, getting your lending structure set up correctly, because of that tax gap. So, and I suppose that's probably a next logical question for you, Rob, in terms of, can you help define a little bit more about what that tax gap is and why it's so important for you to be collecting that money on behalf of the Australian government?
Yeah, Ben. So tax gap probably sounds like quite a taxi ATO specific term, right? But essentially what it means is it's the difference between what we calculate to be the amount of tax that everyone should pay and what they actually do pay. So with respect to rental property investors, as I said, our current calculations based on financial data from a few years ago is that the difference between the amount that is paid and should be paid is about $1.2 billion.
So, and there's a few things that people can, some obvious ones that they can do to avoid being in that gap. You've talked about a couple of things, but is there any others that you reckon would be worthy of highlighting here?
So, Bryce, I think the one we've just touched on, if you are using a mixed purpose loan or you're refinancing or redrawing, make sure you understand the tax consequences of you doing that. The other one is to remember, as I talked about, the loans for 25 years, you've got to apportion that over the 25-year period. And calculations for this can get complex, and so it is really important that you understand the tax consequences and understand the record keeping behind them. That's probably one of the main things we'd say. And our investor toolkit, has a lot of information on interest expenses and how to apportion this and how to avoid not claiming it correctly. As I said, we're going to make sure everyone gets it right the first time, and so make sure you keep good records and you've got your calculations set up from the start, and you understand the tax consequences if you're redrawing or refinancing.
And folks, that kind of bridges the gap between why Ben and I always say get an investment savvy mortgage broker, because you don't want to pollute loans. And an investment savvy mortgage broker knows how to make sure that you don't pollute loans. And the end result of pollution of your loans is exactly what Rob's just talking to that point. Your loans get messy. Your $20,000 trip to Europe then it has to go over 25 years. It's not money in, money out. There's a whole bunch of rules that just makes that loan very unworkable for a long period of time and hard to get out, because it's all about the intent of the loan, not necessarily the security of the loan.